Guys, welcome to Time in the Market episode 6. Today I'm going to be doing my usual portfolio update because I want to focus on changes to the Dividend Aristocrats portfolio. If you remember from my in-depth overview of the Dividend Aristocrats portfolio, this is a portfolio that is made up of the 57 companies that have paid and grown their dividends in the S&P 500 for the past 25 years. As the name suggests, as the description suggests, the companies within this portfolio change as more and more companies pay their dividends for 25 years or more, pay and increase their dividends for 25 years or more. I kind of went over the changes to the Dividend Aristocrats in the past couple of years. Every couple of years or every year, some companies get added as they reach that 25-year threshold, and other companies get removed if they don't grow their dividends or they don't pay their dividends any given year. For example, in 2008, a couple of companies in the Dividend Aristocrats portfolio cut their dividends or didn't raise their dividends. And because the description of the portfolio is that you have to raise your dividend every year for 25 years in a row, if you cut or don't raise your dividend, you get removed. On the other hand, if you reach that 25-year threshold, you get added to the portfolio. So 2019 was a year where a couple of companies were right on the cusp in the S&P 500. They had paid their dividends for 24 years in a row and increased their dividends for 24 years in a row. So 2009 was their 25th year. If they raised their dividend that year, they would hit the mark. They are in the S&P 500. They have raised and paid dividends 25 years in a row. And as such, they're going to be added to the portfolio. So right now, my Dividend Aristocrat portfolio in M1 Finance has 57 companies in it. And these are the companies that as of 2019, January 2019, paid and raised their dividends 25 years in a row or more. This is a good sign because it shows stability. It shows the ability to get cash even during downturns like 2008 and continue paying dividends through tough times, which is always good to have when things may happen around the corner. You want companies that are going to be financially sound and be able to continue paying their dividends. Now, this doesn't guarantee that they will, but it's a pretty good track record. And these companies have shown that track record and are worth investing in my opinion. So there is an index that kind of tracks the Dividend Aristocrats that gets reconstituted every January, towards the end of January. And the index just released the new companies that are going to be added to the Dividend Aristocrats portfolio. And I want to add those to my M1 Finance, which is designed to track that portfolio, that group of companies. So what I want to do today is kind of talk about those companies that are being added and see how I want to add them within my portfolio, how I want to incorporate them within my portfolio. The one limitation of M1 Finance is that you can only do full percentage targets. So I can only do 2 or 1%. I can't split these 64 companies evenly into a chunk of 1.5% or whatever 100 divided by 64 is. I have to do some companies at 2, some companies at 1. So today I'm going to be looking at these 7 companies, what they are, their financial metrics, etc. And then I'm also going to compare them against the other 57 companies that already exist in my portfolio, and also looking at the financial metrics of those companies and seeing, which companies that are currently at 2% do I want to take down to 1% in order to make room for these 7 new companies, and also maybe do I want to take some companies that are currently at 1 up to 1%, up to 2% rather. So it's really a once a year rebalancing of everything, looking at these companies, seeing whether or not the allocations I currently have make sense or whether I want to change them, and also looking at the companies that are being added to the portfolio. So let's look at those 7 companies. I've got a little spreadsheet that I put together using Excel here that lists all of the 57 companies without a color here that are currently in the portfolio and their relevant financial metrics that I like to look at, as well as their allocation targets right now, and then also the 7 companies that are being added and their relevant financial metrics that I like to look at right now. And I'll talk about those metrics later, but first let's kind of look at the companies. I'm familiar with a couple of them. I'm not familiar with others, the new companies that are being added. We've got Albemarle, ticker ALB. We've got Amcor, ticker AMRC. We've got Atmos, ticker ATO. We've got Essex Property Trust, ticker ESS. We've got Expeditors International of Washington, ticker EXPD. We've got Realty Income Corp, ticker O, and then Ross Stores, ROST. So these are companies that have paid their dividends now for 25 years in a row, and not only paid them, but also raised them, which is kind of great to see. So first, I kind of want to look at some of these companies and see what they're all about, what they do, if I'm not familiar with them, if you're not familiar with them. First, we've got Albemarle, which looks like it's some sort of, who knows, power company maybe. So they're a leading global producer of lithium, bromine, and catalyst solutions. So it looks like they make essentially lithium, right? So lithium batteries, things like that, things that power electric vehicles, electric anything, efficient technology, things like that. We're going to look at their financial metrics later, but this is a company that's more on the production side of things, not the service side of things. So they produce things that other companies use. So they are a producer. Much like, if I'm looking at companies that are already in the portfolio here, I'm looking at a company like Archer Daniels, which is producing some sort of item versus being a service company. So already a bit of that in the portfolio, but we'll add a bit more. Then we've got Amcor. I like to go to the About Us page of the company as a starting point. Then I'll eventually go into the investors page when I want to dive deeper into the company. So these guys produce packaging essentially for food, beverages, pharmaceuticals, etc. So I'm thinking plastics, things of that nature, packaging for your medicines, laminate things, really anything. So seems like they do a lot of stuff that you probably use on a day-to-day basis and you probably don't know about. So aluminum packaging, lid packaging, seems like they do things like packaging for your yogurt cups, things like that. So clearly a company that's worthwhile. Hey, lids for your strawberries too. They do a lot of things. I'm not very familiar with this company. I think they actually just came together via the purchase of another corporation, two companies coming together, because I couldn't find a lot of combined financials for them, which is going to be a bit limiting when it comes to analyzing the company. Atmos Energy, these guys work with natural gas, which is a natural gas company. If we look at their investors page, if we look at their About Us page, yeah, regulated natural gas. Looks like they kind of work in the middle America range. Texas here is a lot of their business. A couple of states in like Louisiana, Mississippi, Tennessee, Colorado a little bit, but a lot of their stuff is in Texas and the areas around Texas as well. So a lot of stuff going on. Stock is looking to be around its 52-week high, so it's been doing pretty well. Market cap about 14 billion. Dividend history, you can kind of see, hey, these guys are raising their dividends. If you want to go further back, there's a Excel sheet here, but you can sort of get a lot of this information for a lot of these companies on their investors page. Some of them make it very easy, like this one. You can kind of see in 2014, these guys were paying a regular quarterly dividend of 39 cents. Now it's up to 57 cents. They raised it from 52 just this year, which is great to see. Great to see companies raise their dividends. Seems to speak to their financial prowess. And since these guys are on the Dividend Aristocrats list, that means they didn't even cut their dividend and continued to raise it in 2008. They didn't cut it and continued to raise it in 2000 during the web boom and bust of the early 2000s. So good history here. Not super familiar with the natural gas world, nor am I really super familiar with the lithium world, nor am I really super familiar with the plastics and packaging world. But you don't really have to be with this type of investing strategy because the financials are there. A lot of these companies are relatively easy to analyze because they're producing something. They have free cash flow. They have capital expenditures. You can kind of get an idea of what their earnings are relatively easily compared to their free cash flows and kind of look at it from that perspective. And also there's a baseline of security in the fact that these companies have been around for so long and have paid their dividends for 25 years or more and raised their dividends for 25 years or more. So I do a bit less analysis on these companies than I would on a company that I'm buying an individual stock of, since this is going to be a very small allocation. We're talking 1 to 2% of the overall portfolio. And the portfolio is driven by the fact that I'm just investing in Dividend Aristocrats. I am really perturbed about the individual risk of any of these companies because I think the overall risk of the portfolio is low and the overall reward of the portfolio is high, as I talked about in the video on the Dividend Aristocrats. They have returned better than the S&P 500 since 1991. Their downs have been lower. Their highs might have not have been as high as a riskier portfolio, but their losses have been minimized because there's a trust and value to dividends when things kind of go awry, as they did in 2008, where in certain years the S&P 500 fell 40 to 50%, whereas this portfolio was only down about 20%. Still down, but still certainly more safe than riskier bets. Next up, we have Essex Apartment Homes. Let's accept the cookies. Looks like these guys are all about apartments in the California and Seattle metropolitan areas. So it looks like they are doing pretty well then, because those areas have been booming, and you can kind of see that, hey, they've got some expensive places here. 3,000 to 10,000 in San Francisco. Expensive 2 to 5K in Santa Clara. 3 to 5K really. 3 to 5K in San Mateo. These are all places that are way out of my price range, but seems like they're doing pretty well. So this is a real estate investment trust, which is essentially a real estate holding corporation that pays out a lot of their earnings in the form of dividends, about 90% for the most part. And it seems like these guys are doing relatively well on that front. Obviously, they're in a good area of the country for that sort of investing. Looks like they tend to have very good compound returns, 17% from IPO in 1994 through 2019. It's pretty fantastic. You can't fault them for that. You can't be upset about those kind of returns if you were an investor since 1994, and they are 20 billion market cap, $309 stock price. Doing pretty well. We'll dive into the financials there. Expeditors. I don't know how to pronounce that. Expeditors International of Washington. I think these guys are a logistics company. So they essentially help companies with logistics, which is getting things from point A to point B, doing other things that is essentially all about making things work well. And the thing I like about these guys is that they are very much a service company. They do not really own trucks or anything. They actually spell it out here. We do not own the aircraft, ships, or trucks that they use every day. So they are flexible. They help you manage your supply chain. And with what's going on in the world today with the coronavirus, they actually have it on the front page. Hey, coronavirus is essentially shutting down China for the foreseeable future. There's going to be a lot of need for something like this. So certainly the potential for growth is there. Obviously a lot of risks to every industry with the coronavirus, but if people need help with their supply chain because something's going on with China and they can't get their information, they can't get the things they need from there, and these guys might be getting a lot of business pretty soon. Who knows? And then we've got Realty Income, which a lot of people know. This is another real estate investment trust. They are known as the monthly dividend company because they pay dividends every month versus quarterly or annually or whatever that the payout is. For most companies, they have returned 16.5 average annual total return, so slightly lower than the Essex Property Trust, but still pretty damn good. Both of them came out in the same year, so hey, buddies. Looks like they've paid dividends and raised dividends since essentially they IPO'd, which is great to see. One thing I like to look at when I look at REITs is, hey, who are their tenants? This is a real estate REIT focused on essentially retail, and whereas the other one is focused on apartments. So like with apartments, it's kind of like, hey, apartments, people are always going to need a place to live. Whereas with retail, there is kind of a shift in retail right now where certain companies aren't doing as well as others. If a real estate investment trust or REIT has exposure to a lot of companies that are shutting down, could mean a lot of empty buildings. Right now they have a 98.3% occupancy of their portfolio, which is very good. They've got 49 different industries. But essentially what I like to look at is, hey, what are their tenants? If their tenants were heavily in Toys R Us or something, and those buildings went out of business and they weren't in areas where they could easily change them or rent them to somebody else, these guys might have been in trouble. But right now their tenants are, hey, Walgreens, it's an okay company. 7-Eleven, it's an okay company. Haven't been to either of those in quite a while, but hey, they still exist. I got a number of leases. So 10% of their revenue is at two companies that I haven't really been to. Doesn't mean that those companies are doing poorly, but kind of makes you think, are any of these companies that I think will never have trouble? I don't know. Dollar General seems to be doing okay right now. FedEx obviously doing okay, but with Amazon taking a lot of their shipping in-house? Are they gonna have a little bit more trouble? Are people gonna ship less things, meaning FedEx is gonna make less money? Who knows? But essentially what you are saying when you're buying a REIT like this is you're making not only a bet on the company, but you're kind of making a bet on some of the underlying holdings within the company, because is whether you like it or not, a lot of the performance of this company is going to be driven by the performance of the companies that are the company's tenants, right? So if Walgreens suddenly goes out of business, 5.7% of their revenue is gone, at least temporarily. Obviously, they can take those places, they can change them up if needed, they can rent them to other people, but losing a good amount of their revenue is going to be a problem. Luckily, none of the tenants really hold a massive amount of the revenue here. You kind of see this in other industries where certain companies, like there's certain companies that are so dependent on Apple that if Apple does something that is incongruent with what that company is doing, they're basically going out of business. You know, there were companies that were getting 90% of their revenue for making screens for Apple, and then Apple essentially took some of those screens to another company or started making them in-house, and that company went under. So there isn't that risk here with Realty Income, and they've done well to diversify their tenant base. So, you know, even if, let's say, Regal Cinema goes out of business, they're only losing 3% of their revenue, and they could potentially rent that out to somebody else. So it's not like it's terrible. And none of these companies look really like they're doing poorly. Most of them are, some of them are investment grade. A lot of them I think are going to be around for a while, but you never know. You know, Walgreens, there is a lot of pharmacies out there, especially in my area of the woods. I think there's just too many. Amazon's making a push into that if they do an online delivery pharmacy solution that makes people happy. You know, Walgreens, CVS, etc. could be in trouble. I don't think gyms are going anywhere. You know, FedEx probably isn't going anywhere. 7-Elevens probably aren't going anywhere. Dollar stores probably aren't going anywhere in the short term. But again, you have to kind of decide, if I'm investing 10 to 20 to 30 years out, am I worried about some of these companies? And the reality is I probably am a little bit with Amazon, and I'll kind of touch base on that with my next Dividend Aristocrats. Ross stores, I don't know what the store is, honestly. I've never been to a Ross store. They don't have any in my area. It says my store is East Windsor. I have no idea where that is. So it must be pretty far. It's New Jersey, about 140 miles away from here. So yeah, there's no stores near me. But it looks to be like a Marshall's, TJ Maxx type situation where it's a discount clothing store. Yes, for less. So it's a kind of a bargain hunting store. Maybe a little bit of home goods mixed in. Seems like there's a picture of a bed here in the bedroom. So a lot of that stuff going on. Honestly, I'm not super high on retail. Is there an investors page? Let's see what these guys are doing here. Nasdaq 100 fiscal revenues of 15 billion. So obviously they're doing pretty well for themselves. They have 1,500 locations in 39 states. They also operate 260 DDs, discounts in 19 states. Yeah, I mean, I don't know if there's too much about it. Looks like they've been around for quite some time. They've obviously been paying dividends since about 1994. Got some stores in Guam, Dress for Less. With retail, sometimes I like to go into the stores myself and kind of see what it's about. Like when I was thinking about investing in something like Macy's, I was like, well, this looks very good on a value basis. But then I went into the store and I was like, well, you know, I would never shop here. It doesn't seem like I would want to own something that I don't want to shop in. And I don't see the long-term viability of a store like that. So without being able to do that, I'm kind of iffy about investing a lot in this. But again, I'm still going to, because it's a Dividend Aristocrats, and this is the point of this portfolio, is to kind of invest without thinking about it too much. You know, there's the underlying strategy is, hey, these guys have paid dividends for 25 years in a row. Their financials are solid, obviously. They've raised dividends for 25 years in a row, so I'm going to invest in them and see what happens, because I'm wrong 99% of the time. That's why this channel is called Time in the Market and not Timing the Market. Analyzing stocks is hard, and this kind of makes it easier. So now that we've looked at these companies, let's kind of look at their underlying financials. And what I like to do is kind of look at forward PEs. I kind of look at dividend growth. I look at profit margins. I really like seeing high profit margins in companies, because that means that any revenue growth that they're seeing, they're keeping more of it and able to reinvest more of it into either store growth, revenue growth, or even raising dividends. And then I'll also look at payout ratios based on their forward income and also free cash flow payout ratios if I can find it. Sometimes with some of these companies, it's harder to find it, and some of them don't have any free cash flow. Like, for example, Atmos Energy Corporation had negative free cash flow as far as I could see. I think there's a lot of capex in there that if somebody who knows the industry could analyze, they would see that it's investment capex over general maintenance capex. So I don't really have that insight, so I didn't really dive into the details too much. But if somebody were to do that, they'd probably have a better idea of what that means and exactly how much free cash flow this company is generating. And then other companies like banking companies or utility companies or a real estate investment trust, it's just kind of hard to come up with a free cash flow. So I just don't do it because they're not really free cash flow driven companies. They do other things. There's depreciation involved and things of that nature that make it more difficult to get at that number. So you can look at funds from operation over earnings, and then free cash flow kind of ceases to make a difference. And then also I'm looking at dividend growth, and I'm looking at sales and earnings per share growth and things like that. And then yield as well, obviously, because that's important. So a lot of this information here. We've got some of these new companies are relatively well priced in relation to the market. Let's say the market's around the 20 range right now. Albemarle and Amcor are in that 15 to 16 range, and these other 5 are in that market range or maybe slightly above. What I like to do is look at, hey, what am I getting for the earnings that I'm paying? So I'm paying essentially $23 for each earning of shares. Am I getting good growth? Am I getting good sales growth? Am I getting a decent profit margin or operating margin? Is there potential for the dividend to grow because the payout is low? If the payout's already near 100, it's unlikely that they're going to grow their dividend too much unless their earnings are going to grow. What is their projected earnings in the next 5 years? How have they grown their earnings in the past 5 years? And essentially, what is the market pricing this at in relation to the margins that you're getting? So if I know that the S&P 500 is priced around 20 and the dividend's growing around 4 to 5%, and the profit margin is in that 8 to, I think it's around 10% range, I want companies that are essentially better than that, growing faster than the S&P 500, growing their sales faster than the S&P 500. And if they're priced better than the S&P 500, then I'm probably getting a good deal. And sometimes I'm willing to pay a bit more for a company that's doing those things better than the S&P 500 as well. So if a company's priced at 30 earnings per share, price over earnings, where I'm paying $30 for each dollar of earnings, but their earnings are growing double of the S&P 500, the profit margins are double, their sales are growing, everything's doing well, that's something I'm interested in. So now, the way I kind of look at this is I've already got these 57 companies that are in there at 2 to 1%. That essentially takes me up to, 100, and I have to add these companies here. At the very least, put them at 1% in order to put them in the portfolio. So 7 other companies have to come down to 1% in order for that to happen. And essentially, I want to see how I want to play that out. Initially, if I look at some of these companies, let's look at Albemarle. Good profit margins. Well, I'll make a statement about Amcor. I had a hard time finding information about this one just because they combined into the company as you see it now. It was the combination of 2 different companies. I think it happened in 2019. So really, there's no long-term financial record for this company. And I didn't really have the time to dive into the 2 separate companies to see how they work. So because of that, this one I'm just going to hit with a 1. There's just too many unknowns. I just can't make sense of a 2% allocation to this company because I don't really know it that well. The financials aren't there, and the profit margins are relatively small as well from at least the initial 7 or 9 months of data that I was able to pull. This is the lowest forward PE, and also the highest yield, almost the highest yield, but I just don't have enough information to kind of deal with that to figure it out. Albemarle, a decent forward payout, a lot of room for growth. They haven't really grown their dividend that much, 5%. It's not bad, but it's not the highest. Their earnings have grown pretty well. Their profit margin is pretty good, but again, I just don't know that much about the company. They're 36% above their 52-week low. They've done really well in the last year. But honestly, I'm just not super comfortable about lithium and lithium related companies to know enough to invest more than 1%. So I'm going to go 1 here. And that's kind of a 1 to 2 because the honestly, this is from, if I just look at some of this stuff, Realty Income's got a lot of profit margin, but it's a real estate trust, so those are going to have those. Really, what I'm looking at here is the forward PE based on the funds from operations here, and these are higher than I typically like for real estate investment trusts. I mean, Realty Income, you were able to get that at 15 to 16 at a yield of 4.5% just a couple of months ago. Not a couple of months ago, but about a year ago. It's historically kind of traded in that range. So for it to be in the 21 to 22 range, it's a bit expensive right now, in my opinion. I kind of want to throw these ones at 1 as well, simply because the PEs are a bit high. It's kind of hard to make sense of that. I kind of like Essex Trust a bit more. Their forward payouts pretty solid, and their dividend growth is pretty solid, as is their sales growth. I mean, you can't really be upset about 18% sales growth, so they're certainly utilizing that to grow their dividend pretty well. But I think I'm still going to keep it at 1% for now until the valuation changes. If I come back to this a year from now when I'm doing another review of this and this is down to the 16-17 range, I think these are companies that I would definitely be happy having 2% of the portfolio in, but right now they just seem relatively expensive in terms of their historical funds over cash flow, PE, price over funds over cash flow. Expeditors, for now I'm just going to put all of these at 1 and sort of just look at these, because I'm looking at these in a vacuum, but really what I should be doing right now is looking at these in relation to all of the other companies in the portfolio, because some of them have to come up, some of them have to come down. Right now I have 107% of the portfolio with all of these at 1, so I have to make some room for these cases, for these stocks rather, and remove other ones. So let's start with a simple allocation based on, hey, what's the forward PE earnings of some of these companies? We've got Brown-Forman, which is essentially a distillery. They make Jack Daniels at 35, leading the pack here. These are all at 2%. They've done very well in the last year. Some of these are essentially above where they're targeted to, because they've done really well in the last year here. If you look at some of these forward PE companies, they've returned on average 39% in the last 52 weeks from their highest to the lowest. And right now they're sort of priced around there. So they're up an average of 40% from their 52-week low to now. So doing really well here. Obviously that is going to cause their PEs to sort of go up. And it kind of makes me think, do I want to make any adjustments to some of these companies based on where they're priced? And really, I don't know if I do. One thing I'm wary of is anytime a company has kind of grown a lot and has a high PE, but doesn't show it in the metrics. So kind of if we look at Cincinnati Financial Corp over here, their earnings per share in the past 5 is actually down. Their earnings per share in the next 5 is lower than some of these other ones. Their sales growth is okay, and then their profit margin is okay. But honestly, this kind of bothers me. And if I'm paying a 27 PE for an insurance company, that's a bit excessive in my mind, especially one that hasn't really grown their dividends that much. That's got a payout ratio in the 50 to 60 range, much higher than some of these. Brown-Forman is in the 36 to 45 range, depending on what you look at. This one's in the 28 to 35, 25 to 47, 27, 41 to 46. So this one's definitely the highest of the 4. It's the lowest PE of the 5, rather, but some of the metrics just aren't there. So maybe this is one where I take it down to 1%, because it's a bit expensive right now in relation to some of this growth. With Cintas, I'm getting a 22% dividend growth in the last 5 years. I'm getting earnings growth in the 10% range plus, and I'm getting sales growth that's relatively good, and then profit margin that's pretty solid. So that one, even though it's kind of expensive, there's a lot of room for increasing dividends. So I think I'm okay with that. Same with Ecolab, pretty expensive, but the metrics are solid. The profit margin is a bit lower than I'd like at this PE, but it's still pretty good, and the dividend growth is there, and the prospects of more dividend growth in the future is there. McCormick also pretty solid, good earnings growth, good sales growth. I think I'm going to keep it there. Brown-Forman is one that's kind of a tough one, honestly. I really like spirits as far as investments go, but at 35 PE for something that's growing its sales at essentially 2%, it's kind of hard to swallow. The one thing that really makes it for me is this 25% profit margin. That means they're keeping almost 25% of every dollar that they bring in. So even if their revenue is low, it's essentially, if you compare 2% revenue growth for a company that's at a 10% profit margin and a 2% revenue growth for a company that's at 25%, it's essentially 2.5 times better, because when you get to the bottom line, they're keeping 2.5% more of that money, 2.5 times more of that money, not 2.5% more of that money. So I really, really love companies that are maintaining a high profit margin and can continue to grow their sales and earnings, because that comes down to the bottom line. And honestly, I think I'm overall just a fan of the spirits world. People are not going to stop drinking. The PE is there, but the PE of these companies is generally up there. If you look at Sam Adams, Diego, some of these other high-end producers of spirits and distilled liquors, they're priced high because the expectations of growth are higher. You can kind of see that some of the earnings growth here is relatively high, and their profit margins are just really good. They've got a lot of flexibility to raise prices, and they've shown that they've been able to do that in the last couple of years, and the stocks have performed very well. So I'll put this one as a maybe in terms of reducing it, but if I can't find anything else, I think that's on the cusp. And now that I've talked about how much I love profit margins, I'm at a spot where this stock has grown their revenue really well and has a profit margin of 32%, the P of 26. So this stock is essentially a better version of Brown-Forman, because the profit margin is so high and their PEs are more affordable. I think I have to take this one up to 2. I don't know what I was thinking with the 1% allocation before. So we're kind of moving in the opposite direction, but this is a company that's just firing on all cylinders. I have a hard time ignoring it. They've grown their dividends. Linde, again, profit margins are pretty high. Roper, profit margins are pretty high. And we get to WFC Corp, company that owns North Face, 25 PE for very tiny earnings growth, and essentially just on the cusp of 10% profit margin. They've done kind of okay, not great in the last year. I'm kind of thinking this might be a candidate for a 1% too, simply because if you look at the companies around it, these are companies that are growing their earnings 10% plus, or have profit margins that are almost double what WFC has. And these guys are kind of just ticking along, but not doing great. And to pay a 25%, $25, 25 PE for them, 26 PE, it's a bit excessive, and their payout ratio is already up there. I think I'm just actually going to do it. I'm going to take this one to 1 without even the assumption here. So Hormel, pretty good earnings growth. The sales growth is relatively flat. So this kind of gets you to a similar position as WFC. They've obviously done a better job of growing their earnings. Their dividends have grown solidly. Their sales is flat though. And I don't know. I think they're sort of in a similar financial status as WFC. I do like their business model a bit more than just clothing, because clothing is kind of replaceable. Meat's sort of going to be there. They've got the scale that's hard to replicate, whereas with clothing, stuff goes in and out of style relatively quickly. I don't know if there's a ton of value in some of the WFC brands. They're good. I know I own a North Face jacket. I own some Timberland boots. But at the end of the day, if another company comes in and does things just as well or better at a similar price point, I think it's going to be tough sledding for some of these companies. ADP, very solid here. Tough to make a case against this company at this PE. Very good margins, good growth, good sales growth. Now we get to Coca-Cola. These guys are paying 67% of their earnings. Dividend growth, they're paying 25 PE almost for negative sales growth, negative earnings growth. Good profit margins. That's what I love about Coca-Cola. But, are these guys kind of at the cusp of where they're going to go? Like, where's Coca-Cola going to go now? It's still a company that you certainly want to own, but is the growth there to warrant a 25 PE? It seems very expensive right now. Like, I'd definitely be buying Coca-Cola at 15, at a 17 if it was below the market, because the profit margins are there, but they're not growing. They're not really growing their earnings in the last couple of years. Their sales growth has been negative, so I don't know about that. 25 PE for that. It's a staple. It's not going anywhere, so it's certainly going to do well during a recession. But I think it's still going to fall quite a bit given where it's priced today. And I kind of have the same opinion about Procter & Gamble, on that one for me is just a definite 1%. I'm paying 24 PE for a company that has grown their dividends at 3%. The earnings are shrinking. Sales have gone nowhere. And the profit margin is 5%. No thanks. This company has kind of outrun its value right now. It's done very well in the last year, but I just don't see how it's worth as much as it is right now. And I'm kind of in the same spot with Sherwin-Williams. Like, this company has done really well as well, but can't get rid of paint. But really, the only thing that's keeping me from reducing this one is this. Like, if you look at their sales growth, it's insane in relation to everybody else. The market's growing at 2%, 3% inflation. Some of these companies are growing a bit higher. These guys are growing at 11.5% in the past 5 years. That's tough to beat. And also, they have just plenty of runway to raise their dividend when they want to, right? This could be a company that eventually, once they stop growing a bit, their dividend could double, triple easily. They could start raising that dividend 30% a year, and I want to be there for that. So this is one that I'm keeping. Clorox is another one that's kind of in that same ballpark as Procter & Gamble, really, that you're paying a lot for a company that's not. Where are they going to go? Like, they're not going to grow that much. There's only so much you can do with cleaning products. There's only so much you can do with some of this stuff. So I think this one is kind of has taken the runway it's been given and run with it. But right now, I just don't see the value there. So Atmos, we kind of talked about. This one at 1. And this is not a bad company, right? You're paying a 23 PE for a 17% profit margin. If the sales growth was there, I think I'd bump it up to 2, but it's just not, so we'll keep it at 1. McDonald's, again, negative sales growth, but profit margins right out the roof. So this is kind of similar with Coca-Cola, that I think these guys are doing solid. They're certainly not going anywhere, but you're paying a decent amount for growth that just isn't there. And maybe that'll turn around, but just because of the name, I think I'll keep it. But that's another one that's a maybe for a reduction here. Colgate Palmolive, it's already at 2%. How's this one? This is kind of in the Procter & Gamble ballpark, where I think I take this one to 1, just because the sales growth's not there and the profit margin's good but not great. I think I'll take double profit margin even at slightly lower growth rates, because they're obviously doubling earnings here. Then Ross Stores. I sort of like Ross Stores, but it's retail. Some of this retail stuff just is a tough pill to swallow for me, because I'm paying 23, a PE of 23 for a retail store. And obviously these guys have executed fantastically well. Their profit margins are solid. Their growth on both the sales side and the earnings side is very good. But again, how much of that is same store sales? How much of that is driven by just opening new stores? That's really something I have to dive into more. They've got a ton of runway for dividend growth. Their payout's only in the 20% range. They have grown their dividend 20% every year over the past 5 years. That's really damn good. but I don't know if I want to go to 2% on a retail store at this point with where the retail landscape is. I've already got a lot of exposure to retail in this portfolio through a variety of ways, whether it be food producers or clothing producers or food makers. The consumer staple and the consumer discretionary here is very well covered. So I just don't want to overweigh it. And I'm certainly taking some of that down via Procter & Gamble and maybe Coca-Cola and Clorox. But I don't know. This is one that I'll come back to. The financials are just really damn good on this one. PepsiCo, this is similar to the Coca-Cola story, but you're paying less for it. You're paying 23 versus, what was Coca-Cola, 25. But you're getting less. There's less of a profit margin, and then sales are slightly better. Earnings are solid. These guys are buying. So then we get to Walmart. Walmart's one where I'm kind of iffy on it. So there's obviously a lot of potential for them to expand online, but that's a gross margin hit. They don't have the cloud and other areas of the business that Amazon has to kind of support that expansion. And over here, you're getting 1.6% sales growth in the last 5. You're getting essentially earnings shrinkage, 2.8% profit margin, so very tight margins, and I'm paying 23 PE for that. Kind of expensive. It's higher than the market. I don't know if this company is better than the market. I'd rather just invest in the S&P 500 at these valuations. Things could change, but right now I think this is a 1% investment with where it's priced. ITW, good profit margins, very low sales. Dividend growth solid. APD, this one is free cash flow. The free cash flow is kind of a concern in the last year, but I don't know if that's an aberration or not. Their forward payouts looking pretty good. Their free cash flow is a bit of a question mark, as was Coca-Cola in the last year. But again, I think some of that is just a one year situation that will do better in the long run. But I think these companies are still worth investing in, right? The profit margins are really solid here. I'll come back to these later if need be, just because the sales growth isn't there on these two. Really like Essex, really like Realty, but I think the valuation for these guys is a bit tough. I think if these guys dropped into the 17-18 range, I'd be all in. Definitely a 2% for these two guys, but right now I think I just want to stick at 1. Then we got Cisco over here. 20% decent sales growth, low profit margins. This is another one that we might want to consider just because the profit margins are so low. And then we kind of start getting to some of these sub 20 PEs where it's less clear. So I kind of want to go back up there and arrange by profit margin and see if there's any changes I want to make. So T. Rowe Price, highest profit margin. I have that at 1%. Very good, payout is low, plenty of room to grow, 11%. Forward P of 15. Sales growth is great. Earnings is great. Profit margin is the highest in the portfolio. I have it at 1%. Do I want to change that? I don't know. T. Rowe Price essentially sells mutual funds. This is a very competitive landscape. I think these guys have done relatively well recently, but I just don't know if I want to have that much exposure to this landscape. I think it's the reason the PEs are so low. If you look at Ben Franklin, another one here, Franklin Resources, Templeton at 1% that I changed not too long ago. These guys are obviously doing a lot worse. T. Rowe Price is doing a lot better. If I just look purely at the financials and ignore my gut, this seems like a 2% adjustment. The yield's pretty solid. The payout ratio is there. The dividend growth is there. The sales growth is there. I just don't know if I can ignore my gut. I just don't like the business that much anymore. I certainly am going to have exposure to these guys, but if I'm investing in investment management, asset management firms, I go with things like Brookfield Asset Management that actually owns their own stuff. I don't want a company that I can buy mutual funds from. I just think that's a business that's not going to be where it is right now 20 years from now, and that's kind of where I'm investing. So I'm just going to keep it at 1. despite the nice financials. SX already talked about. McDonald's, very good profit margins. It's hard for me to sometimes look at these and say, you know, I want to reduce McDonald's because their profit margin is just so damn good, and it's McDonald's. They're not going anywhere. I'm going to keep that at 2. I've decided. They're going to do fine. This is a decent price point for a company with a profit margin that's almost 3 times the market. People's United profit margin doesn't really matter for banks. It's always high, so I'm going to keep that at 1. Again, Realty we covered. Similar spot for FRT, which is on the REIT. I think I'm going to keep that at 1. No real changes there. I don't want too much exposure to REITs right now with how low the interest rates are. If they keep, they're essentially priced where they need to be priced because the interest rates are so low. There's a lot of risk on the opposite end if the interest rates start to rise a little bit, but for now I think they're doing well. APD, where am I right now? Do I need to make any changes? We're at 102, so essentially we need to remove 1% from something else. 17% here at a 16 PE. It's decent. Sales growth isn't really there. ITW. Let's go in the opposite direction, and let's go at some of these small PE profit margin cases. So CAH already have at 1 negative profit margin in the last 12 months. Not great. ADM at 1. Cisco, I've got at 2. Very low profit margin. Sales growth is okay, though. PE is okay. But not great for the profit margin and the sales growth. Do I take that down to 1? These guys, these guys provide food, right? And these guys do the lunch at our job. Or they used to, at least. I think we switched. And they suck. If these are the guys I'm thinking of, I just don't care for the product that much. What the hell does Cisco do? I'm trying to look it up on my phone, but I'm pretty sure these are the guys. So let's take this one down to 1%. I'm not a huge fan of the stock. Given the profit margins are relatively low and the PE is pretty up there. Got a lot of 2% here. We got Lowe's companies, decent PE here. Decent growth on the sales side. Walgreens has actually grown their sales pretty well at that PE, but again, I'm not really in the Walgreens business. We've got Target at an 18 PE, so slightly better than Walmart after they fell a little bit. We've got those guys at 2%. Then we've got an 18 P for ExxonMobil, shrinking sales. Guys have really gone nowhere in the last year. Similar situation with BDX. Who's with sales? Let's go with negative sales here. Pentair, this is misleading because they sold a bunch of their business, so ExxonMobil is next in line. Chevron is next in line. Is ExxonMobil versus Chevron? Do I reduce ExxonMobil and just call it a day? Pretty good yield on those guys, but they're paying out 103% of their forward earnings, 83% of their payout. Let's go to dividend growth. Most of these guys are at 2% on AT&T. A lot of debt there. Not a huge fan of the stock, honestly. That's another potential. Chevron's not really growing their dividend that much. And their profit margins are relatively low. Walmart's already there. Procter & Gamble I took down. Consolidated Edison. Do I love these guys? Not really. Emerson Electric. These guys are not growing there. They have 62% of their forward earnings. Who's high over here? So Amcor. So ExxonMobil is a bit high on their forward payout. Realty income's a bit high. Chevron's a bit high. Coca-Cola's a bit high. 3M is a bit high. I kind of want to just reduce ExxonMobil. I already have exposure to Chevron. I'll still have a decent amount of exposure here. These guys have gone really nowhere in the last 52 weeks. Gas prices are sort of ebbing and flowing, but mainly doing poorly, and I don't really see that changing. And some of this is obviously conjecture, but I think I'll just go to 1% here, and that should do it. That'll get us to 100. Essentially what it means is that I'm taking all of the new guys. I'm putting them at 1%. Yeah, I said I was going to come back to Ross, but for now, since I don't know a ton about these companies, I want to do more research, and they're being added newly to the index. I'm just going to put them all at 1%. The changes I'm making here, I'm taking WFC from 2 to 1. I'm taking Cisco from 2 to 1. I'm taking Colgate-Palmolive from 2 to 1. I'm taking ExxonMobil from 2 to 1. I'm taking Clorox from 2 to 1. I'm taking Procter & Gamble from 2 to 1. And I think I'm taking Walmart. Oh, Cincinnati Financial from 2 to 1. Walmart from 2 to 1. I'm taking S&P Global from 1 to 2. One that was already in the index just because their financials are freaking amazing. Huge profit margin and good growth. Overall, I really can't fault these guys. And that gets us back to 100%. So now we're sitting at 64 companies instead of 57. Back to 100%. I'll make these changes Monday morning. So I probably won't do a rebalance. I'll just start adding money in. So I'll just buy a lot of these companies and let these other companies try to sort of, maybe I will do a rebalance. Although I'd probably have to pay taxes on that. So we'll see how it goes. But that's it. That's really it. Really, I want to take a couple of minutes here, probably way longer than a couple of minutes, to analyze some of these new companies. Again, this is a very high-level analysis. I really didn't dive into the details on a lot of these corporations because the idea behind this investment strategy is to sort of be very high-level on all of it. I'm buying these companies because they are dividend aristocrats. They have paid and raised dividends for 25 years in a row. The real analysis, the only real analysis that I'm doing here is kind of very high level. Hey, which ones do I want to put at 2% and which ones do I want to put at 1%? And I'll do that every year when I do this analysis based on whether or not cases are added or removed. I keep saying cases, stocks are added or removed. So I think this is going to be good for the next year. I don't expect any changes. I'm pretty happy with where my allocations are. So we've got, how many stocks do we have? We've got 36 stocks at 2%. We've got 28 stocks at 1%. So some higher than others. Really, I wish M1 Finance would just let you do a average allocation, so that'd be 100 divided by 64, and I didn't really have to do all this analysis because I don't want to, but I'm doing my best and sort of thinking, hey, these are the companies that are going to do well, these are the companies that are going to do poorly. Here's 2% to the ones that are going to do well, 1% to the ones that are going to do poorly. That is sort of timing the market, maybe in a way. I don't love that. I'd rather just allocate it equally. If that's what you want to do, there is an ETF for that, NOBL. It does charge a 0.35% expense ratio, so you're losing out a bit there. And hopefully with some of this analysis, I'll end up beating that, but who knows? I've done pretty well in the last year, but who knows how it will do in the long term. So that's it for today. Thanks for watching. If you would like more videos, hit the subscribe button. And if you want to watch some other videos, there's a playlist down below that I'll link to. I do use M1 Finance. I'll post a link to this portfolio and the other portfolios I talk about during these series in the show notes. But until next time, thanks for watching and have a great day, guys.